a very warm welcome to a very special expert session regarding business finance. We do hope that by now you have thought of what you are making as a digital product, have done the marketing flyers, and now we are coming on to a very special week of the business finance. It entails very important part of your digital product and its pitching. Okay, you must know what are the basics of your product and its related finances. So for that, we have invited a very special guest, Mr. M Gowri Shankar. Very warm welcome, sir.
Thank you.
Yeah, he's a CA. He belongs from Trivandrum, Kerala. And I will let Mr. M Gowri Shankar to introduce himself first. And then, since this is a session in a fireside chat mode, I'll be asking questions with M Gowri Shankar, which are more related to the students from 7th to 12th class. And he will just answer in a very simple language. And I request all of you to please leverage this session as much as possible, gather his wisdom as much as possible, because not every day you find these people coming onto our platforms and giving us such wisdom. Very warm welcome, sir. Please introduce yourself and then we can go ahead.
Thank you, Shubham. Thank you for the opportunity at the outset. My name is Gowri Shankar. I hail from Trivandrum as of now. I'm a chartered accountant, qualified in the year 1988. I used to work for Pricewaterhouse in Chennai and Ernst & in Middle East in Dubai office. I have a mixed bag experience. Currently, I'm in practice in Trivandrum in the assurance side of business. Right? I have about 3 decades of accounting experience, accounting, auditing, assurance experience, controls review, due diligence, SAP implementation, Oracle implementation, a mixed bag, and then project management side of. I was the cost control manager and finance manager projects in brownfield, greenfield, aluminium smelters in Middle East, in Dubai in particular. Right? That's my brief background. Currently, I am in practice in Trivandrum.
Thank you so much, sir. So, students, you can understand with over 3 decades of experience, how much the professional seasoned he is. So, without further ado, I'll just start the session. Mr. Shankar, we have divided the session in majorly 3 parts. Okay, first one for the students, we'll just understand the basics of the business finance. Okay, and the other session, what we'll be doing is getting familiar with the business, finance, and accounting terms in a very simpler way. And the third would be what are those knowledge, skills, as well as the tools and technologies which are available for the students to gather that wisdom. Okay, so sir, first thing first, this is a Tinkerpreneur boot camp which we hold annually as a government of India. Okay, since the students are right from the 6th to 7th class, first they need to understand the terms called as business finance and business accounting, right? So in a very simpler way, what is business finance and what is business accounting and what is the major 1 or 2 differences between them?
Okay, quickly before that, I need to tell you, business accounting means recording, analyzing, interpreting the day-to-day activities of any organization or any business, right? In a small company, typically it will be done by 1 or 2 people, but in large organizations, it will be a team. There will be specific roles. It will be done by different teams, right? This is accounting. Accounting is recording of all transactions happening in a business on a day-to-day basis. Coming to business finance, finance is a bit larger term. Finance means money. Money is needed for running any organization, like for purchasing assets, goods, raw materials, and other running expenses. So business finance is about bigger picture, whereas accounting is does a day-to-day activity. Like if you go to a bank, they have to close cash. It's a day-to-day activity. For loan activity is a ongoing because it's finance, because they lend money to various borrowers. So finance is a bigger term. Accounting is a day-to-day function. Finance means they think of strategy decisions. It's a bit more a wider term. Accounting is day-to-day activity. Hope I'm clear.
I guess perfectly placed, sir. The finance is a much broader term, and accounting is like keeping pace with your money in a day-to-day manner. Okay, how do you manage your money? Okay, fine. Sir, these entrepreneurs, these students who are participating in the boot camp, okay, are kind of an aspiring entrepreneurs. They are devising their digital product for the first time. Okay, so in your experience, why is it important for them to keep track of their money for their business, and what happens if they don't do it?
How many of you watch cricket? I hope almost all the guys who's listening to me, including me and Shubham, watch cricket. 20,
Yeah,
20,
there are
50,
many raise of hands, sir. Yeah.
right?
There are almost 90% raise of hands. Yeah.
Okay. Imagine a situation where there's no scoreboard. What happens to the match? The guys keep on bowling, the guys give. So what happens? If there's no scoreboard, will it be interesting to watch a cricket match or any football or anything? Accounting is like a scoreboard. It records all the transactions, the conscience keeper. Without record keeping, you won't know where you're heading to. So that is the fundamental importance of bookkeeping and accounting. I have made it very clear. This looks very simple, but it is. If you don't have a scoreboard, how boring will be the match? You won't know whether you're winning or losing. What happens? Target is not there. You won't. I mean, you won't know which way you are heading to. So accounting is so important. Even not only for business, even for personal accounting is very important. How much you earn, how much you spend is more important. I'll tell you for business, it's very important for even for individuals. Suppose if you're earning salary, if you're salaried people, right? You should have accounting for your own kind of spending. One third, one third, one third rule. One third spending, one third saving, one third investment. That is a normal general lifestyle you should follow. So accounting, record keeping, even for personal is very important. Business, so it's even more important.
No, I guess people now understand ki, okay, why is it important to keep track of their money in their business? And sir, if it is that important, they must see some source of funding to run their business as well. What are the different sources of funding which are available to run the business? And
Before,
yeah,
go on, please, sorry, go on.
yeah,
Sorry for
and
that.
how do these funds help businesses run day-to-day operations as well?
Okay, before we get into finance, I need to tell you what are accounting. There are 5 things in accounting: income, expense, asset, liability, and equity. Income, people know general what you earn, expense what you spend, asset is what you own, liability is what you owe, equity is owner's capital. So these 5 elements govern the bookkeeping and accounting. Okay. Source of finance. I said a term equity, owner's capital. I'm the owner, I can put money. Right? In some cases, I am rich, I have money, so I can do this. Suppose I have not enough money, so I can pool in with somebody else. Right? Joint holding, which means I myself, my friends put together can source funds and then crowdfunding. Third one, debt. Debt is when you borrow money. It's very tough for startups to borrow, but there are various schemes in government of India which they are announced for startups. So you can go to the bank and finance. So it's called bank finance. It is all the lending that will be commercial terms. There is another source of finance, which is the unregulated market, where the finance cost will be very high. So there are owners capital, debt funding through banks, and debt funding through unregulated market, right? Through relatives, through friends. It is different from capital. Capital is where you don't expect return. When debt is there, you have to pay interest on the fixed debt, right? The cost of debt is high. So there's a distinct difference between capital and debt. The owner's fund, I don't expect, if you make profit, you take it. Whereas in bank financing, if you borrow money, you have to pay interest and you have to pay the principal also at agreed times. So those are various kinds of funds, sources of funds available for business.
Thank you, sir, for putting light into this. I hope by now the first section is clear for the students. What is business finance? What is business accounting? Why is it important to keep track of the money for the businesses? And what are the different sources of funds and those five terms which has been put by sir. Thank you. Now we are getting to the round two kind of a situation to understand what is business finance and accounting and their terms. Sir, this is right now, I guess, the most number of questions from the students. Okay, they are not able to understand in a very simple way what is actually the working capital. What is it and why is it important for businesses? What happens if businesses is short with the working capital?
As a term, working capital means you need money for running the business. There are two aspects. One is for funding for capital assets. Suppose if you want to do some, for example, some IT services firm for that matter, right? A startup in IT services. You need to buy computers, hardware, and stuff. That is called one-time expenditure, right? There we put some working capital. You need to pay salaries for the developers, marketings, everything. That is all day-to-day, month-on-month expenditure. Rent, your utility bills. So you need to have sufficient money to run or to meet those obligations on a timely basis, like your electricity bills, your rent, your salaries, your other marketing expenses, which means you should be able to match your revenues with to be able to meet the current obligations on a month-on-month basis. So this is called working capital. Generally, banks do finance for term loans for the purchase of acquisition of assets, building and machinery. And they do have something called working capital finance, which means you should be able to pay salaries on time. If you can't pay salaries on time, what happens to the employees? There'll be some sort of unrest, right? Your reputation at stake. And you should pay your vendors on time. You should pay your government duties and taxes on time. If you can't pay all those things, it will be a problem. So you should have enough, at least enough money to, and for this, you need to be planned properly. How much your expected income and what are your fixed monthly outflows, so that you should be able to meet minimum all these obligations on a timely basis. This is called working capital, which enables you to keep on operating on a month-on-month basis. It's like a fuel for your car, which keeps you to operate, or your motor car that keeps running. Am I clear?
Sir, yeah, if you can give a very simple example of working capital.
I don't know how many of them will understand this. There are two things called in the balance sheet: current assets and current liabilities. Current assets are stocks, receivables, and cash. Whereas your current liabilities, because there's some question which I see, payables and receivables. So, I mean, your current assets should be equal to current liabilities, which means all the obligations repayable with at the short notice. So that should be, you should have enough money to pay your current obligations, which means your salaries, your rent, your electricity bills, your other bills, which happens on a regular periodic basis.
Oh, very well understood, sir. The working capital in simpler terms is the fuel to run your business, and
Correct.
you should have it like with you to kind of balance your payables and receivables. Yeah. Yes.
How do you do it? You just plan, you do the resource forecasting model is there. I think I heard somebody did the business modeling. Like that, you do you do projection for your cash flows. That's where the cash flow projection helps you. How much expected income you earn, how much expected outflow. Yeah, outflow is probably pretty fixed. Income also you can reasonably estimate or guesstimate. So if we see the shortfall or excess, if it is excess, you okay, shortfall, then you would go arrange those gap either through own capital or through bank finance or to some other source of money, so that you know you are not defaulting on these monthly obligations.
Yeah. Yeah.
This is very critical for any startups.
Yes. Perfectly.
Very critical. Very critical.
Yeah. Yeah. And sir, in the continuation of working capital, we know that these businesses spend money on a regular basis, on a day-to-day basis. Okay, so in this context, can you help understand the difference between the purchases and the expenses? and the components of the purchases as well as expenses in the business terms.
Okay, purchases depends on which type of industry you're in. Suppose I'm in a retail, for example, I'm in the fashion industry, right? I am selling ready-made garments, right? And I stitch material also, which means I buy fabrics, I buy ready-made garments, and to stitch, I need to have buttons, all those things to make the shirt readily for sale. So those are called stitching items, materials. So these raw materials, which is purchased for manufacturing the goods for resale, is called purchases. To some extent, you consume utility, I mean, the power and fuel also for running this machinery. So to the extent of the production, yeah, all expenses incurred for producing a particular goods or service is termed as purchases, which will go in cost of goods, right? Other than that, your miscellaneous expense, your entertainment bill. Suppose a customer comes in, you're taking him for lunch. That's not purchases, it's expense. You pay taxes to government, municipality tax, building tax. That's not purchase, it's expense, right? What goes into production is called purchases. What is not very critical to production is called expenses, entertainment expenses, your miscellaneous expenditure, your interest expenses, right? Am I making some difference in here? Purchases means anything relating to production of goods or services purchase will be classified as purchases. Anything which is not core to the purchases will be termed as expenses.
So expenses are not directly related to production. Yeah. And purchases is directly related to production or the cost of goods.
Predominantly raw material.
Yes, yes, perfect. And sir, since we are talking about money, how do businesses making money? Okay, and in this context of making money, what exactly is revenue for businesses?
Right. Money is revenue is the income inflows generated from the core activity. For example, again, I go to my fashion or retail business. Yeah, I sell my goods like t-shirts, shirts. Like for example, Peter England or Aditya Birla, they sell garments. Anything arising out of your core activity is called revenue, right? With the process, you keep some money in the bank, you deposit some money in the bank for, because you don't need, you may so keep it the money, bank pays you interest on those deposits. That is called other income, not revenue. Any inflows arising on core activity of your business is revenue. Anything arising other than core activity is called other income, right? So how do you make money? You sell all your products at a profit, definitely above cost. So anything sale minus cost of goods sold equal to gross profit, which is the trading profit. And you have other establishment expenses. If you remove all the establishment, gross profit minus your established expenses will give net profit. That is the money available to the owners. Which means you should always target to maximize revenue, minimize your cost of production and other expenses, which means you should be aware of your cost. Unless you are aware of your cost, you can't control it. What makes you aware of the cost? Again, goes back to the basics of record keeping. See how it's linked. Unless you keep proper record of your transactions and tells you what I have spent, you will not be able to be aware of your cost. Unless you are aware of the cost, you can't control it. Unless you are aware of your revenues, you can maximize it. So ultimately, it goes back to the fund basics. Record keeping on a timely basis is an ultimate discipline, which is a must, non-negotiable must. That's where you make money. Even $1 counts. $1 saved is $1 profit. So you need to be cost conscious at the same time. Be smart enough to understand how the expenses, where is it going, what are the leakages, and how to control it. We'll talk about it later.
Yeah, I guess that perfectly put. This is how the cycle runs. You must be aware where each money is going, and you must be aware where all the money is coming from, so that you run a business, right? That's how you make money. So yeah. Now coming on to the important terms further, you have already like mentioned somewhere about the payables, receivables, and so sir, what are those? What are these three terms, particularly in business parlance? Can you give a very simple example for our students to understand these three
Right.
terms very simply?
I stick to my same example,
Sure.
fashion industry, right? Which is currently I'm working on them, so that it's easy for me to give example. Or else I can give manufacturing. For example, I am in the aluminum manufacturing industry. For aluminum manufacturing, what is raw material? Alumina, right? Whatever I buy for production will be termed as trade payables. Either I can pay in immediate cash or I can pay within 30 days. The credit terms, if you write a purchase order, I mean, there's a question of POs. I go to the vendor, say, listen, I want this material, delivery term so and so date. I will pay you within 30 days from the date of receipt and acceptance, right? So that is called payables. It's generally called trade payables, 30 days terms. In fashion industry, there's no credit, it's a cash. So I go to the supermarket or I go to a fashion store, I buy my dress material, I swipe the card, I give cash or pay through UPI and come back, which means it is cash on delivery, which means I have cash in hand. I get, when I sell the product, I get cash immediately. But when I buy the raw material, I get 30 days credit, which means this is the bid offer spread. This is time you should use your money effectively to generate more money and pay. Generally, in other industries, there will be credit terms for even sale, credit sale, which means I take the goods from you, I pay within 30 days or 45 days from there, which means I get 30 days credit period. I have to pay my vendors, I get 45 days from my customer, which means you lose 15 days. That's bad planning, which means you should receive cash in advance or lesser than 30 days before you try to pay the vendors, which means, or you should be equal, right? So that you manage your obligations and your income properly. Generally, you try to have a cash on delivery or lesser credit period for your receivables and more terms, extended payment days to your vendors from whom you buy raw materials or other things for your business. Is it clear?
Yes, sir. Means very clear in the sense you explained by taking the example. And we have already told students if there is some doubt, they can put it on the chat box. We can take it later as well. That is not an issue. So
Okay.
perfect.
Payments, there's one thing called payments. Payable is different. Payments
Yes.
is settling those liabilities. It's called payments. Payments can be through check or through bank transfers. Nowadays, people rarely write checks. It should be NEFT. People do online transfers, bank transfers, so that check writing is slowly moving away. So payments means settling the liabilities arising on purchases or expenses. So payments is different, payables are different, and receivables, they are totally different concept. Receivables, you have to receive money from your customers. Payments, I mean, payables means you have to pay to your vendors from whom you bought goods. Payments is for normal payments. So these three are totally
Yes.
different.
Yes. Yeah. Perfect. And sir, if you are talking about payments, what exactly is a purchase order, a receipt, and a receipt and an invoice? Very simple word terms. And why are these documents needed and important for our business?
Right. Suppose I am buying something from a vendor. For example, I'm buying a fashion industry. I'm buying fabrics from Raymond's, right? Unless you tell him in writing, dear Mr. Raymond's, I want 100 meters of this particular rate, because generally rates are agreed. The quantity and rate is fixed, right? Or there are formulas in which the rate will be agreed upon a particular formula. That is the rate, the methodology of rate fixing also are mostly fixed, which means you know this happens, the price is this. If this happens, price is this. So that the formula of pricing is also agreed upon well in advance. So only the quantity remains variable at all times. So I know so much of quantity at so much rate. So you place an order on the vendor, telling him to say, you please supply this on so and so date to so and so address. That's called written signed by the authorized signatory. It's an official document signed by the company to the seller, asking him to supply those goods and materials at the specific address, because it's a legal document, GST number, everything is placed on the purchase order. It's a legal document actually. Based on this only, the supplier will send the goods to your premises. While sending the goods, he will attach something called delivery challan or goods receipt. The person in the receiving end will acknowledge, yes, I received this particular material on so and so date, so and so quantity, everything is correct. That's called goods receipt. And then based on the goods receipt, the supplier will send the goods receipt, acknowledging receipt by the warehouse with the invoice. Invoice is the one, okay, you ordered 100 meters of fabric at 100 rupees, 10,000 rupees plus taxes. Which goods are delivered to the warehouse, acknowledgement is there. You attach that acknowledgement along with the invoice. Invoice is the one, it's an obligation for you to pay the vendor, which means for the receipt of goods. So purchase order, GRN, invoice. These three are very important, without which you can't make a payment. If I raise a purchase order, when the invoice comes, will you make a payment? You shouldn't. Why? Because you don't know whether the goods received in the warehouse or not, which means the goods receipt is very important. This is called three-way matching. Your PO, your GRN, and your invoice all should be in sync. Then only you can make payment. In some cases, the PO may be for higher quantity, the delivery may be for a less quantity. For example, you order 100 quantities, he supplied 50. A GRN will be for 50 and invoice will be 50, which means there the rate will be fixed. 50 times 100 times, that's the rate, that's the quantity, invoice will be for 5,000 rupees. So purchase order, goods receipt, invoice is primary. These three should be in sync for making payment to the vendor on the particular date. You can't, if you say 30 days time means if I receive the goods on first, I should make the payment on 30th. These 30 days, I'll be using this material, converting them into product goods for resale and sell in the market, generate money, pay the vendor. This is a business cycle.
Yeah. Sir, there is one question in this the student is asking. So, for example, X and Y, one is a client and one is a vendor. They have come into a purchase order. Okay. And as you said, ki out of 100, let's say 50 has been given and 50 is remaining. So that 50, the rate of that 50 will remain fixed, or it would be fluctuating if I want that order to be delivered after 6 months.
It depends upon the pricing formula. Suppose if your product is governed, for example, I am buying alumina. Alumina, the price determines the London Metal Exchange, right? So it is a percentage of aluminum price on the London Metal Exchange. So you can't have the fixed. It depends upon the pricing formula. If you're buying a normal fabric, it will be fixed. All depends upon the terms and conditions you agree with this seller at the time of entering into the agreement. Either a fixed price or a variable price or a formula. It depends upon the each and every type of agreement which you enter into, which is seller with the manufacturer.
Yeah. So to answer this, I guess we must also say to students that the purchase order has both the things. One is definitely the fixed price and the terms and conditions on which that price has been fixed.
Correct.
Yeah. Okay. Now coming on to being judge of my business financial health. How good is my business running? So eventually we come up with 3 basic sheets which we tell to students to maintain. And this might be a bit challenging for the 6th to 7th grade student to maintain those sheets. We will be just going a very simple context. Okay, why these 3 sheets are important. These 3 sheets, namely, one is the income statement, another one is the balance sheet, and third is the cash flow statement. So, sir, in a very simplistic terms, what are these 3 things and why is it important for us as a business to maintain, to gain some valuable insights on our business health?
Right. Quickly, income statement refers to your operating activities, right? Your sales, purchases, expenses. Okay, it summarizes your revenue or routine activities for the period or for the year ended. So it tells you how much you sold, how much you bought, how much you spend on salaries, how much you spend on production, everything. It tells you gross profit, net profit. So it's always for the period ended or the year ended. It summarizes the activities of a business for the particular period or year end question. Again, going back to record, this all comes from the record keeping. Unless you maintain the records properly, do monthly transactions, this will not be perfect. I'm telling this again and again to students because bookkeeping, financial discipline is a very, very important for any successful business. Unless you have financial discipline, you will not succeed. Let me tell you this upfront. For example, I finished my June quarter, first quarter ending, right? Today I'm sitting in July. I have done the accounts for my client for first quarter ending, ready for discussion. I finished my accounts, last year accounts in May. March accounts was the period ended. Year ending was March 31st. I am done with my accounts in May 8th itself. I'm ready to sign off, which means reporting deadlines and month end closing. So you know exactly what's happening, which means your financial discipline is very, very important. Thus triggers the income statement. Income statement, from income statement, you go to balance sheet. Balance sheet is the one as a snapshot of you, what assets you own and what are the liabilities you have settled down. What you owe and what you own. It's a snapshot of your assets and liabilities as at a particular end date, reporting date. Assets, your fixed assets, your cash and bank, your receivables, your stocks, your prepayments, all comes in asset side. Your liabilities, your capital, your payables, your profit, everything comes in the liability side. That's balance sheet. Cash flow. Cash flow is very, very important. Banks, your investors will analyze all this cash flow statement very, very carefully. Why? It tells you where you are spending money, either investing or financing or operating activities. Cash flow is divided into three elements: cash from operating activities, cash from investing activities, cash from financing activities. Operating activities, your sales, purchases, increasing all of that. Investing activities, how much you invest in business, acquisition of assets. That's called investing activities. Financing activities, how much money you're borrowing or how much money you're settling in the banks, how much capital bought by the owners. All these three elements put together comprise your cash flow statement, right? These three documents together comprise is called the financial statements of a particular organization. The format may vary depending upon the type of business you are in. Either the company, the format is the format is dictated by the company law. Companies Act 2013. If the partnership plan, it's a different format. So, but all these three important documents are a must, non-negotiable document which banks will ask, or you should prepare it for your own self. So income expense comes in the income statement. Asset, liability, and equity comes in balance sheet. And where the money is, how the money has been spent or where the money has been used is determined in the cash flow statement. So these three are very integral part of your financial reporting system.
So, sir, individually speaking about these three statements and sheets, how do one can judge their business health?
Right. There's something called ratios. If you give a single number, it doesn't excite me. Right? If my sale is for this year is 1,000 crores, nobody's bothered. But if last year was the current year, last year was 600 crores, this year 1,000 crores. Suddenly people wake up and say, hey, what's happening? Which means any number on an isolation doesn't make sense. Which means you're in financial statement, there's always comparators. Current year, previous year. Which means you can compare and see what are the where all you've done well, where all you're not doing well, where you've done extremely badly. So that these numbers will trigger some discussion, action points. These are actual numbers. Going before that, this companies or business will prepare something on budgets, annual budgets, right? Your forecast, how much I am going to earn, how much I'm going to spend, which means while preparing this budget is accounts, you should compare with the budgets, whether I've done in line with the budget. This is a monthly activity. Budget review will be a monthly or a regular activity, which means I have budgeted for 10,000 rupees. I spend only 7,000 rupees, which is you're doing good. What are the reasons for doing good? Suppose you budget 10,000 rupees, I spent 15,000 rupees. What made you spend? And what is the thing which changed between budget and actual? Because budget is done sometime before the event is happening, whereas actuals happen later. So budget is based on some assumptions. So budget plus this will tell you how you're doing and comparatives. And there's something called ratios. Your net profit ratio, your gross profit ratio, your current ratio, your turnover, there's some methodology, there's some ratios which we can compare and then understand whether we are doing good or bad. If you're making profit, doesn't mean you are doing good. Profit also you should have made more. So your profit ratio current year you compare. Last year I made 10% profit. This year I made 8%. Number wise it may be higher, but I'm 2% down. Why? So there's some percentages, ratios are there, indicators. There's some standard books available. It's very easy to pick up. Just number ratios between denominator, division of some sales by purchases. You know what is the percentage of cost of sales. GP ratio, compare current to previous year, net profit ratio. We'll throw where you have done well. So all those, there are certain techniques, tools available, which we can easily understand how you're doing good. Coupled with your budgeting process, which means budget review is a monthly activity. This income statement, balance sheet, cash flow is a yearly activity or a reporting quarterly activity.
So by analyzing these sheets, we get to know both where is my business running currently, and it also helps for me to do some bit of a forecasting for the next year or the next month. Yeah.
Correct. This financial accounting is a baseline activity. With this only, you'll be able to do budgeting. Very important for any startups, or because I should know where I'm heading towards.
Yeah. Yeah.
So I'm going to help you to prepare your forecast.
Right. Okay. So students, we are done with the 2 rounds. Both the rounds was most focused about what are the business finances, accounting, some important terms which you should know right from this stage, so that you can also have a tight grip on your business accountings as well as business finances as well. Now coming on to what are those skills you need to become a good manager for your business account. So, sir, according to you, what kind of a knowledge or skills these students must possess to manage their accounts better?
First, they should have a hawk-eye for detail. Right? I mean, as you must know, auditors are bloodhounds. I mean, you see the number, you should know why it is like this or why it should not be like this. How you know that? You should be in and through the numbers. Accountants are always living with 2 things, numbers and dates. Right? These 2 are very important for any chartered accountant or for that matter, any financial accountant, because it tells you how am I doing. You keep on, because once you see the number, the trend will throw you what's happening. So you should be very good in your number. Hawkeye, I mean, you should be always understanding what's happening, right? Your forecasting ability, your comparison with the peers. For example, I'm in a business, right? How are my competitors doing? You should have the market knowledge. And what are my competitors doing in the same field? How are they performing? What are the things which are new in the business? Okay, for example, any simple project like a restaurant, right? What is new in a restaurant? Like, for example, kitchen order ticket. Previously, if, for example, my friends running restaurants, they'll come and take order. What do you want? Tea, coffee, those. Now, you can sit in order in the table and it tells you how much is going to cost. So you can keep on, how much money you have in the pocket, you can keep on ordering. Sitting in the table, you can do this. That's new technology. And unless you confirm what you want, you say, yes, it goes to kitchen. And then the guy produces, comes to your table, which means what is ordered is produced and what is produced is billed. See the link. The emerging trends in numbers you should know. First of all, you should be good at forecasting. You should understand how these numbers are made. For that, you need to, I don't need to be accounting knowledge is different. These are business skills. Understanding numbers, understanding ratios, understanding trends. That's very important. People say, oh, finance is very difficult. Finance is not difficult. You forget the accounting, any tool, any simple tool will do. Arising out of it, how you understand those numbers. What does it tell you? Each number will tell you a story. Each and every number in the accounts will have a data behind it. For example, salaries, right? How the salaries, what is the function of salary? It is a function of headcount plus times the number of average salary per headcount, correct? You should know what determines that number every time. So if it is more or less, you should know if my headcount is less or more. What has changed in that equation? You should, each and every number will have a statistical key figure. For example, your advertisements. I told about salaries. Headcount times this average salary will give you the salary cost. It should be close to that. For your advertisements, what is based on number of insertions, TV commercials, times the cost per insertion. That will tell you how much it should be. If it is like that, if it is same or more or less, you should understand. So that each and every number in the accounts will have a hidden truth, which you should be able to understand. Intrinsic quality to a number, should be able to understand that number. If you get that truth properly, rest is magic.
Yeah. No, I can fully understand, sir. And so students, there is no one particular mantra. You should be having an hawkeye for detailing. Know what your business is doing, particularly what is coming, what is going, and just have an eye for detailing, particularly the numbers. That is what right now you can start doing it with your digital product. Sir, day to day in newspapers, social media, we come across some kind of a news on having some unethical practices as well in business accounting and financing. So, sir, what steps can these businesses can take to avoid such fraud and unethical practices in managing the accounts?
Right. In the previous session, I told you PO, GRN, and invoice. I said three-way matching, right? Payments can be triggered only if these three documents are in place. Like that, this is called internal control process. It is strong, which is called maker checker. If I am the person who receives the material, I am the person who receives the invoice, I am the person making the payment. What will happen? Instead of 10 receipt, I'll put 100 receipt. I'll ask the vendor to give invoice for 100. I'll make payment for 100. I split. There is no maker checker concept. Everything I'm doing myself. Even I can sign checks. Orders different, which is what the very worrying. In small organizations, the payment option will always be with the owner, which means the guy accountant cannot do anything, which means he will check. There are in small organizations, the internal maker checker is very difficult, but it's very important. Maker checker, am I clear? Maker is something, checker is different, so that the chances of fraud is mitigated. I won't say it will be zero, it is mitigated. Right? Therefore, the simple things, PO, GR, invoice, it's called three-way matching. Right? And system will not allow duplicate invoice. How? Because there's no receipt. Same invoice cannot be posted twice. Without a PO, GR will not be raised. Without GRN, invoice cannot be booked. See the controls, I mean, now these are standard feature in any accounting software. It is inbuilt in the accounting tool. Nowadays, previously we have to design this. Nowadays, it's standard. All the control process mechanisms is inbuilt. So need not break the head. But you test it. Anything, you test it for positive test, negative test, and stress test. This is the must for anything you should do. Whether 1 plus 1 is 2, 2 is okay, don't stop there. 1 plus 1, if it comes 3, you test whether 3 is coming or not. You should test that also. You should do positive test and negative and stress test. Anything you do this, you'll be able to control all these things. Generally, your internal control process should be very sound. Nowadays, all the accounting tools are enabled with this, but maker checker is human, is outside system. That needs to be very strongly enforced.
Thank you, sir, for putting light to it. And sir, since you are mentioning about the technology, what are those important available for small businesses to manage their business finances and accounts?
There are enough and more tools of Tally Prime, Vyapar. For example, if you're doing some hotel business, I mean, there are enough and more software available. Tally is one of the best user-friendly software available. I think all by now, I think you must have heard about it. Tally Prime, it's cheap also. Even pirated version is very cheap, and normal version is very cheap. They are very easy software. I mean, at affordable prices, software is available in the market. But the standard best features available. Vyapar, Tally Prime, Sage, ERP, Syspros, your Reach, ERP. Next, you Google it, you'll find n number of software, and what fits you, you please decide in your industry, because accounting differs from type of business or even. What fits retail will not fit manufacturing. What fits manufacturing will not fit your restaurant business. So there's some fine nuances, but that's okay. We will learn. People will learn by experience.
Sir, one of the booming discussions right now in each office places is AI. Okay, and we have seen the intervention of AI in almost every field. So has AI been used in business accounting too? And if yes, is there a risk associated by using AI in financial decisions?
15 years back or 20 years back, I don't know when these guys were before born, they would not have been born also. When computers were introduced in banks, oh, loss of jobs, right? Imagine the situation, no computers, COVID. What would have happened to all of you? I never stepped out of my house. I spent 18 lakhs in 8 weeks. Hospital bills. night 12 o'clock, I didn't go to the bank also. In that what 6 weeks, 8 weeks, I spent about 18 lakhs not going to the bank. What happened to computers? If computers are not there, imagine what would have been my plight. So AI is inevitable. Anything, any change is inevitable. Please embrace it. Don't resist it. If you resist, you will be a failure. Computers coming in, people losing jobs. No, computers coming, people are getting more jobs. Why? Because they'll be more. We don't need doers. We need thinkers. AI will enable you to it will reduce your dull monotony. It will make your life easier. Automate what is repetitive should be automated. What is automated should be replicated. And what is replicated should be scalability. That is the trick of the trade. I mean, don't keep doing the same thing again and again. You should learn at least one new word every day. So AI will help you all those because don't reinvent the wheel. Payment of salary means debit, same credit. So you don't need to break. System will do it automatically for you. There are autopilots. Pilots, if you see the cockpit, you'll be scared to fly. They don't navigate it, autopilots. Only takeoff and landing they do, and the rest is autopilot. So you spend time more effectively in understanding your numbers rather than don't be scared of AI. AI is a part and parcel of life. Use it for your business and leverage from it. AI is very good, easy. For example, ChatGPT comes in. I don't need to spend time in writing English. I just, brother, please tell me how to write letter. 2 minutes. As a chartered accountant, please draft letter to my client for year-end balance. 2 minutes. Thank you. 2 minutes. Matter over. If I had to write everything 2 hours, I can spend effectively in a different way. There are enough and more tools. Use it effectively. It is not going to take away jobs. It's going to make life easier and more easier. And the only thing you should embrace it.
I guess very nicely put, sir. Everything has a pros and cons. It's all depends on the individual and businesses how they want to leverage it. Best. Yeah, sir. This has been a very wonderful session. The students in the next week would be launching their digital product and online business store. Any tips is you have an experience of more than 3 decades, right from the student age and till now a seasoned professional. You might have seen so many entrepreneurs as well. So any kind of a tips for these students on how they should proceed ahead for their product and keeping their business finances well?
First of all, many congratulations for these young guys who's going to make their life entrepreneurs. I'm not an entrepreneur. I'm a accountant. I'm in service, right? Even though I'm in business, but I'm servicing clients. Important thing is networking. If you're online business, you should be a network biscuit, right? You should be known to people, right? Only when you are known, what happens next? It generates traffic. When you generating traffic is not easy. Without your networking, you cannot generate. And particularly, I heard Shubham saying it's online business, correct? Online business means networking is very important. For that matter, any business networking is very important, but online is even more important. Needless to say, it's very, very important. When you're networking, then you're known, and then the traffic comes in. Traffic, how it comes in? You can use search engine optimization techniques in your online portal so that your name comes first. Then after traffic, you convert visitors into customers. First you network, generate traffic, and from traffic conversion come visitors to customers. See how things move. Networking is the first point, then generate traffic, and visitors will come to your site, and then visitors to customers, and then strong brand. Unless you have an excellent product, unless you know the brand, who will come to you? You tell them about your brand. Once your customers, you start doing customers, then the brand builds up. Then keep on building the brand and then manage cash flows. You are the winner.
Yeah. Thank you so much, sir, for encouraging our students. 2 questions which have been put on the chat for you. Okay, I'm just reading. I don't know, sir, if it is very related to this session, but it's been a curiosity from the student side. How I can decide the best price for my product? How can do that strategic pricing?
I don't know how many of them have an economic background. the price is a function of supply and demand. I don't know how we'll value that. If there's too few goods, too many people chasing, the price is high. If there are only 100 apples, 1,000 people chasing it, maybe 10 rupees. 1 lakh people chasing it, what is the price of apple? 1 million people chasing the apple, which means too few goods, too many people. That so it's a price is a function of supply and demand, whether how the market appetite. Suppose the same, if for example, Louis Phillips shirt costs 1,500 rupees, people may buy it. Suppose sale means 2 shirts, people go and buy in sale. They wait for sale, which means what the market can accept. It depends upon this law of supply and demand. So there's no ready-made answer, but you should test the market. I mean, I can't give this price always a function of supply and demand. That's the law, that's the rule. But there are exceptions to it. Like for example, Rolls-Royce car will always cost heavy, whether you take it or leave it. Rolls-Royce, right? Diamond Rolex watches, made to order, that will cost so much. Whether supply or not, Rolls-Royce, Rolex watches will cost so much only. This is an exception towards your supply of law and demand, right? More the supply, less demand, your price will be low. More demand, less supply, price will be, it's opposite direction. Both your supply and demand works in the opposite direction. Less the supply, more demand, more price. So it is subjective, depends upon what the market can accept, what the customer is willing to pay. That also determines the price.
Sir, the last question of the day. So one student is asking whenever they do an online order, like from Swiggy, Zomato, or something like that, the businesses tend to force to do the debit card or a credit card payment and not encourage the customers to do the COD, the cash on delivery. So why is it so? Is it like it impacts their payables and receivables?
Let me ask you, you are the restaurant owner, I'm ordering the something on you. Will you accept cash on delivery? What is the risk on cash on delivery? I cannot even take the delivery. So the product is wasted. The restaurant owner will, it will become waste for the cost. Nobody will accept cash on delivery unless it's a different ball game altogether, right? So it is cash on delivery is very least preferred option of business. It's risky also in online. Suppose the guy takes the money and goes away, what happens? You can cancel the order last minute. What happens? You manufacture, for example, I order a pizza, right? Unless you pay for it, you won't even produce. If you say cash on delivery, I change my mind, I go to Subway, the pizza comes, I said, can I cancel it? Then what happens to the Pizza Hut? He'll be at loss. So cash on delivery is a very risky type of business. Please never get into that unless you are sure about the conversion rate.
One last question, sir, since you were speaking, one more question came. So this student is developing a kind of an ebook, which is a subscription based and can be placed on Amazon. Okay, so what she's asking is right now there is a cutthroat competition on placing these ebooks. Okay, so how do I make, again, the question repeating is the same. In this cutthroat competition, how do I get to know, okay, this much price, the customers will buy more, or this much price, the customer will not buy more?
There's something called, there's a marketing tool, test marketing, right? Seeding marketing. So you should develop all this, you should do surveys. I'm not a marketing expert, but these are all proven marketing techniques, test marketing, seeding market. You should, who are your competitor? Are you the only one doing this, or is anybody else doing this? If you're only one doing, then you are virtual monopoly. You can decide what you want to do. Suppose I have Raymond's, I have Mafatlas, I have Bomber dyeing. So it's same fabric. So competitors are there. So you should understand what the competitors are doing, which means you should be aware of the market scenario. You should know the ground in which you are playing. Is a level playing ground or unlevel playing ground, uneven ground, you should know. If you are monopoly, then you are the king. Then seller is the king. If you are not a monopoly, then buyer is the king. You should understand that particular economics and scenarios in the market.
Sure.
Have I explained this question properly?
Yeah. She has put a thumbs up to it. So thank you, sir, for joining us. It has been a great session. You have made each and every term very clear, and we have already written to students. If they have further more doubts, we can forward it to you. And if in any spare time, if you can clear those doubts, that would be wonderful. Yeah. Again, thanks a lot, sir, for joining this session. This has been a very wonderful, and the feedback which we have already receiving is immense, very nice. So thank you.
Thank you very much. Thank you once again for giving me opportunity. I'm honored. I'm pleased to take any more help to anybody who can run business.